I think that the gold industry is probably at its healthiest shape in decades.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
What's up, guys? Jay Martin here, CEO of Cambridge House, and I am joined by Ronnie Stoeferle, the author of In Gold We Trust and a fund manager at Incrementum. Ronnie, it's great to see you and have you on the show.
Hi, Jay. Good to see you. Happy New Year.
Happy New Year to you too. You know, as I was preparing for this, I was looking for content that you were creating and sort of trying to get myself inside how you think. And there is a podcast episode that you did in December on the Macro Voices show with Eric Townsend. It was the holiday special. So it was yourself, Eric Townsend, Grant Williams, and then Patrick Ceresna was moderating this. It's a 2-part podcast. Each episode is maybe an hour and a half. Mm-hmm. I've listened to each episode twice now at this point. It's really, really good. And There's a lot of people that do, that have conversations like this, YouTube, podcasts, whatever. Macro Voices is one of the best. That's, I never miss an episode, but I really was, I thought it was awesome. So I recommend everybody check that out. And from that, Ronnie, that's where I want to start. You've, correct me if I'm wrong, but you're pretty set in the inflation camp for the next decade. And that's a point of debate in a lot of the guests that I have on this show. And so I wanted to start with that and just get you to share some thoughts on why you think 2020 forward, we're headed towards more inflation than we've seen in 30, 40 years.
Yeah, well, Jay, I mean, we just published a special report on inflation. It's called The Boy Who Cried Wolf. We published this book. It's called Austrian School for Investors a couple of years ago. So this is basically our core competence when it comes to investing. So we really focus on inflation sensitive assets. And I think that, there's quite a lot of different triggers that really lead to this paradigm shift that we're seeing from a basically 40 years disinflationary environment to increasingly inflationary environment. And that's what we wrote the report about. And, this makes me really excited. And I think it's no coincidence that gold was up 25% last year, that silver was up 45%, that tips are rising, that commodities in general are rising. I think those are all signs that commodities and inflation are increasingly becoming a topic. It is definitely not mainstream. I just attended some outlooks for 2020, and I can tell you that the big houses, they don't really see inflation as a big threat. They don't regard commodities as a viable investment class. So I think we're still pretty early on.
Now, why are you getting pushback or disagreement on this concept? What's the rationale for pushing back on inflation?
Well, of course, we have seen some analysts right after 2008, 2009. They were just staring at the balance sheet of the Federal Reserve and the ECB, and they were screaming and warning people of hyperinflation. Yeah. But I think that's not the full picture. Many people tend to forget that actually we shouldn't blame central banks all the time, that most money actually is created in the commercial banking system. And I think that's already one of the big differences. If you compare 2020, let's say the COVID crisis, to 2008, 2009, this time around, also the broader monetary aggregates like M2, M3 are rising significantly. M2 was up more than 25% last year. M1 was up 60%. So I think this is one main difference. The second one is if you have a look at inflation expectations, Well, actually, in 2008, 2009, I think it took, after the crisis, it took 2 years to climb back to the inflation expectation level that we had before the GFC. Now, those inflation expectations, actually, they spiked upwards pretty quickly. And this is a sign for me that central bankers and politicians, they really want to avoid this deflationary pressure, whatever it takes. And I think the fact that we have seen such dramatic measures, the Federal Reserve basically buying corporate bonds, many steps in just a couple of days, and then this enormous amount of fiscal stimulus. I think this is really telling us that the reaction to the crisis was completely different, and it was significantly higher than in 2008, 2009. So going forward, I would say it is something that we see with some caution. I think that the mainstream yet is not generally concerned about inflation. But once we get above this 2% limit, and let's face it, central bankers, they are very openly telling us we want more inflation. We want actually inflation numbers to overshoot significantly. I think then at some point, equity investors will get very, very nervous. And I think at some point we will see the introduction of a yield curve control, but only as soon as the equity markets really get nervous.
Okay, I'm with you. So if you're right, and we're headed towards increased inflation in the 2020s, I've heard you made an interesting comment about the average age of fund managers, and I think you were referring to probably the US and Europe being around 49 years old, which is to say they've never managed hyperinflation before, right? And
exactly.
So you reach out to your network in places like Brazil where they have.
Yeah.
And so talk to me about that, Ronnie. What have you learned, and how does that impact your decision making to hedge against inflation if that's coming?
Yeah, well, Jay, I've been traveling back in the days when traveling was still possible. I did presentations all over the globe, and I think that the best questions regarding gold were asked in Turkey. I did a big presentation in Istanbul, and I was really stoked about the level of sophistication when it comes to gold in Turkey. And therefore, I think that, in the industrialized world, for the last 40 years, we didn't really experience any significant price inflation. Now, of course, we can discuss how inflation is calculated. We can discuss all those baskets that are highly subjective and so on. But in general, we didn't see any significant amount of price inflation. But if you go to Brazil, if you go to Latin America in general, if you go to Asia, if you go to Turkey, for example, those people know how to navigate in a highly inflationary environment. And for them, for example, they've got a completely different mindset when it comes to bonds. They've got a completely different mindset when it comes to foreign currencies, and they've got a completely different mindset when it comes to gold. So for them, it's just natural to hold gold as some sort of a fixed income or currency hedge. So I think this is really something that people should focus on. And, at the moment, we've got $18 trillion invested in negative yielding debt. Portugal just joined the zero or below zero club. And I think, that's really the big question. So once we go above a certain limit, let's say it's 2% or 2.5%, I think there might be an exodus from the bond market. And I think it will flow into all those reliable inflation hedges like gold, like commodities,
Okay.
Also perhaps real estate and some equities. But I think this will really create a big market move. And having a look at markets now, I think this has already started.
Interesting. Okay. So you manage a fund at Incrementum. You mentioned gold, real estate, and hard assets in general, commodities. And I'm seeing this trend, a trend of capital from financial assets to hard assets. But talk to me more about how you're positioning your clients right now, Ronnie.
Well, we've got an inflation signal that is telling us when to play offense and when to play defense. And it switched to rising inflation in spring. And since then, we've got the highest allocation that we ever had in our fund. So we invest in mining equities, especially in the gold and silver space, but also in the copper markets, in battery metals, in base metals in general, energy market, of course. We invest in the Bloomberg Commodity Index. There's a future on that. Then in commodity or inflation-sensitive currencies like the Russian ruble, where we bought 10-year bonds, for example, highly sensitive, of course, and highly correlated with energy prices. But you get an almost 8% yield on that. But also the Canadian dollar and the Australian dollar are highly sensitive when it comes to inflation. And yeah, so that's basically the allocation that we have. At the moment, it seems that the US dollar, which is probably the most important price to follow at the moment, besides the yield curve, I think that the US dollar is poised to make some sort of a move up, a correction within this downtrend that started last year. So for the shorter term, I expect some more pressure on this commodity space. But I think, we always said that it's first the gold market that starts moving, then we want to see the confirmation by the silver market, then it is the broader commodity space, base metals and so on, and then energy. And I think this playbook worked pretty well last year, and I think we're in a bull market because this is really, we should not forget that nobody is really invested in commodities at the moment. We shouldn't forget, if we should really see this move from a deflationary mindset to an inflationary mindset, I think we're still pretty early on. And then on thirdly, I think that, commodities are generally extremely cheap, and not only on a relative basis, but also on an absolute basis. So that makes me pretty excited about the commodity space going forward. But I think for the next couple of weeks, I expect the US dollar to bounce.
Interesting. Okay. Well, I want to dive into that a little bit, the commodities specifically. When you talk about looking at copper, silver, et cetera, how do you play those markets, Ronnie? Are you buying the specific equities? Are you buying the commodities? Talk to me about how you position capital.
Yeah. Well, first of all, I forgot one major macro thing that I wanted to mention. I think the fact that Janet Yellen will become the head of the Treasury. This has a enormous symbolic sign. I think that she was a big duff at the Federal Reserve, and she will be a big duff at the Treasury. And it reminds me a bit of the 1960s when a economics professor called Walter Heller, he advised Lyndon B. Johnson, and actually they had to fight two wars: the war in Vietnam and the war on poverty. I think that going forward with the Biden administration, and Biden already made this clear that the new round of fiscal stimulus is only the beginning. So they will be starting fighting the war on poverty and inequality, the war against COVID, and the war against climate change. And I think this will be another important trigger. This marriage of fiscal policy and monetary policy. This is a really big paradigm shift going forward. Now, when it comes to commodities, We're pretty bullish gold and silver. This year, for the very first time, we published a special chapter on silver in our In Gold We Trust report. I see it as a probably from a long-term view, I'm probably most excited about silver actually. But going down into the commodity space, I like the energy markets still.
Okay.
We saw this surprise cut by Saudi Arabia, basically. So they will now produce 8.1 million barrels, which is far lower than the 11 million barrels that they produced in springtime when they had this price war with Russia. And I think that going forward, we are moving into a world where the US is a structural oil importer and a dollar exporter. So from my point of view, shale oil was a big capital destroyer. More than 350 billion US dollars was lost in the shale oil patch over the last decade. And I think, at the moment, the energy sector is 2.5% of the S&P. When oil was at $10 per barrel back in 1999, energy was 5.5% of the S&P, and now we're trading at $50. So I think that energy going forward will be one of the most interesting investment opportunities in the commodity space. We also like the uranium space. We've got one uranium fund that is doing very, very well. When it comes to the base metals, I would say that in general, some of the mining stocks are really some sort of a free option on the green revolution. If this electrification is happening, we will need nickel, we will need copper, we will need lithium, you name it. And I think, having a look at the sales numbers, for example, over here in Europe, just to give you some examples. In France, Germany, Italy, Spain, and the UK, the volume-weighted EV share rose to 15% in November. Germany has the lead with a 20.5% share. Of course, those electric vehicles are heavily subsidized. And if there wouldn't be those big subsidies, I think those sales numbers would be significantly lower. But if you have a look at, the agenda of politicians, we can expect much more of this green stimulus. So I think in the battery metal space, there's still an enormous amount of opportunity. We like copper, we like nickel a lot, we like lithium. Mm-hmm. And yeah, as I've said, I think the uranium space really got, it kind of woke up in the last couple of months. Mm-hmm. And this is another topic that we're really excited about.
Okay. Now and I'm with you on that. I think when you're looking at the battery metal space, the safest bets are copper and nickel, and then probably lithium, although it's sort of in abundance, so maybe less demand pressure there. But I want to pivot a little bit because you are, I don't know if I call you the minority, but you're one of the gold analysts, gold authors that also has exposure to Bitcoin. And that's more common than it used to be. I mean, if I go back even a year, 2 years, if I were to talk about Bitcoin on this show, my hard asset investors would just click unsubscribe and walk away. I argue, you can't turn a blind eye to something. It'll only hurt you if you do that, just because you don't like it. But walk me back to, because you positioned your clients in Bitcoin. It's obviously proved to be a very smart decision today. What turned your head and drove you to get exposure towards cryptocurrencies?
Well, actually, through my network and friends and people that I really enjoy listening and talking to, I discovered Bitcoin pretty early on. I think in 2011, 2012. And I found out that actually, there's really, really bright minds out there. Of course, there's many lunatics out there as well, but I met really some of the most clever and insightful and most well-read people ever in the Bitcoin space. And actually, there's I think Bitcoin was created to revolutionize our monetary system. So I think there is many analogies between gold and Bitcoin. So I really don't understand why this is such an emotional topic. And when I'm talking, we're writing the In Gold We Trust report for 14 years now, and when I'm talking positively about Bitcoin, people treat me as if I was cheating on my wife with my mother-in-law or sister-in-law, whatever. It's like, it's so emotional. And I say, I like competition, and I like competition between currencies, and the markets should find out what the best currency is. So we chose I would say pretty prudent way to navigate and to manage exposure in the Bitcoin space. So we've got a 75% strategic allocation in physical gold and 25% Bitcoin with the rebalancing. So as soon as we go to 40% Bitcoin exposure, we just cut it down and we take profits. Now, I think that using options, this is something for sometimes for retail investors, it's not easy, but for us as institutional players, it is something that we use quite a lot. And actually, this enormous volatility that we're seeing in Bitcoin is also a huge advantage. So we are writing options. I think we're writing puts and covered calls, which is extremely attractive due to this enormous volatility. So basically, we get this stability in gold, and we get the convexity in digital gold, which is Bitcoin, and this gives you a positive skew in your portfolio. And from my point of view, at 40,000, it was pretty high, and it was a bit like this Soros reflexive way. It is going up just because it's going up. So at the moment, I would say correction is definitely something that has to happen sooner or later. And I don't know if it's going to go down to 20,000, whatever, or significantly lower. But for us, with this way of managing it, actually it doesn't make a big difference. So we don't have a a strong view for the shorter term. But I think this trend that we're seeing, that now really big institutional players are getting into Bitcoin. This is really something that we haven't seen in the 2017 bull market. So now there's really big names coming in, and back then it just wasn't possible due to regulatory issues. Now you've got pretty liquid futures market. You got an option market at the CME. It has professionalized. So I think the market isn't a kid or a teenager anymore. It has really grown up, but it's still pretty young. And this volatility, it scares many people, but we see it as a big opportunity.
Yeah, that's interesting. Okay. A question I get asked a lot, Ronnie, because when we talk about Bitcoin on this show, often the conversation is, well, look at the 2017, 2018 cycle and the crash and the exodus of capital and all this stuff. And I was running technology conferences those years, 2013 through 2019. So during the 2016, 17, 18 rally, we couldn't find enough cryptocurrency content or exposure for our audience. And people were literally storming into the events, tearing the curtains down if we had anybody on stage talking about Bitcoin in that sort of December 2017, January 2018, when the peak was. And, the argument against that these days that I often hear is like, well, that was retail driven, right? It was retail capital driven. This time it's different because it's bigger, more conservative, more sophisticated money. And the counter argument that I hear to that, though, is that yes, but when a big fund manager like Paul Tudor Jones or a macro personality like Raoul Pal enters the space, they make headlines. And that alone is almost self-fulfilling because it encourages more buying, raises the price, reinforces their good decision. but they're not going to make headlines when they sell, right? They can leave quietly through the back door and just on the back of an excellent trade. What do you think about that concept?
No, I totally agree. I think Paul Tudor Jones won't say in a Bloomberg or CNBC interview, well, guys, I'm selling now. I think it's pretty similar, with Warren Buffett and buying a stake in Barrick Gold. From my point of view, of course, a bubble is a bull market in which you don't have a position. So if you look at people who dismiss Bitcoin as a bubble, they never have a position. From my point of view, I think the most important driver really is the fact that the stock to flow ratio of Bitcoin is pretty similar to the stock to flow ratio of gold. So it is interesting that Bitcoin has no reference value. So this makes it pretty unique. So no matter how its price rises or falls, the pace of productions just follows this preset path, which is halving every 4 years. And that makes Bitcoin really different to first of all, fiat money, of course, but also to most of the commodities. The supply of gold isn't really extremely price sensitive, but of course, at $4,000 gold, we will have significantly higher gold production. So I think this an asset that has finite supply but no intrinsic value, this could really become priceless. And as I've said, Bitcoin fascinates me. I think there's bright people in this space, and we shouldn't forget. If I talk to the boy of our neighbors, he's playing Fortnite all day and probably night long. Somebody's told me that Fortnite has like 6 billion in revenues. Kids are spending more on games than for movies and for music. So I think for them, it's just natural to get rewarded by digital money in those games. So psychologically, they're conditioned to accept and understand and probably also trust digital money. So this is really something that most people tend to forget.
Okay, I'm with you. And I just got to say, I love that quote. A bubble is a bull market in which you don't have a position. How true is that? Okay, so I want to wrap up with just a quick commodity forecast. You've talked about nickel, silver, copper mainly, and gold, of course. Silver being the top performer in 2020. If you were to have to call, and I think I know what your answer is going to be, but if you were to call out the top performing commodity of 2021, what would you say, Ronnie?
Tough one. I would say it's gonna be silver or nickel. I think, we haven't talked about the mining space. I'm really excited about valuations in the gold mining space and also in the silver mining space. Fascinating what happened in 2020. I sometimes really felt, attending those big conferences, I thought, well, this is a value conference. I'm seeing pristine balance sheets. I'm seeing high free cash flow yields. I'm seeing rising dividends. So that makes me really excited. And I think, also in the junior space, there are tremendous opportunities at the moment. So, I really look forward to 2021.
Okay. Yeah. And you're absolutely right. I see the same thing, especially with the majors, healthier balance sheets, more competent management than there's been in a decade. My portfolio is pretty spec. I like to go quite early stage in the exploration business. It's, just the gambler in me, I suppose. But talk to me about how you position on that food chain. Do you stick with the miners and the producers? How early stage do you like to go, and what do you look for, Ronnie?
Well, actually, in our fund, we're managing our risk basically based on our inflation signal. So our inflation signal is pretty strong. So that means we're taking more exposure in the silver mining space. We can also take more exposure in the junior space, and so definitely we have got a very aggressive view on the mining space at the moment. I'm seeing fantastic drilling results from some of the companies that we own, and I just see this enormous lack of capex, this enormous lack of drilling investments that we saw over the bear market, and therefore I expect M&A will pick up dramatically going forward, but this is not our main case, because most of the companies that we own really have attractive valuations. And the good thing, they don't need a gold price at 2,300 or whatever. They're still making decent money at current price levels, and this is really one of the big differences compared to the last bull market. I think that most companies, especially the majors, they've got a very conservative pricing at between 1,200 and 1,300 to calculate reserves and project economics. I think they managed through the COVID crisis pretty well. So we didn't see any. Of course, we saw shutdowns, but I think the companies reacted very, very early, and I would say, and this is a pretty bold statement, but I think that the gold industry is probably at its healthiest shape in decades, but valuations don't really reflect it. Because let's face it, when gold was trading at 1900 in 2011, the gold bucks index, the HUY, traded at 600. Now we're trading below 300. So this is really what excites me. We have seen some interest coming in from generalist investors, but nothing really big. And I think this will continue. Because, and that's what I'm seeing, talking to many institutional players, I think that gold is really, it used to be some sort of a satellite investment, but for many investors, it is really it's becoming more of a core position, because everybody knows that we will see negative real rates for the next couple of years, and negative real rates are the perfect environment for gold. And I think, with COVID, the debt levels already before were unsustainable, but now they're significantly higher. We're seeing, for example, the total domestic debt outstanding as a percentage of GDP in the US is almost 400%. In France, it's 648%, and in the Eurozone, 539%. So good luck with growing out of that. So this is, first of all, the case for inflation, but primarily this is the case for negative real rates over the next couple of years.
Yeah. Okay. That's a great conclusion to wrap up a lot of the things you said earlier. I know I've used up my time, but Ronnie, it's been great having you on the show and introducing you to my audience. I'd love to do this again sometime.
Absolutely. Anytime.